Well, it was another rollercoaster week for the financial markets last week. The shenanigans involving Credit Suisse and its subsequent takeover over the weekend by UBS dominating the narrative here in Europe. But across the pond, banking issues persist. Concern over the regional banking sector in the US remains as risks spread after the collapse of Silicon Valley Bank a couple of weeks ago. This and the risk aversion that resulted from that has caused a huge rally into the bond market, into the treasury space. Haven demand has come into the FX market as well, while trade in the equity space has been very choppy and very, very volatile indeed. Looking ahead to this week, the market is now trying to see whether the banking instability is set to persist, whether we start to see contagion into other parts of the economy, or whether all is okay and we can start to breathe a bit of a sigh of relief. Amid all of that, we've got an FOMC decision and one from the BoE on deck this week as well. Just the sort of volatile risk events that markets really need right now. Plenty to discuss in this week's Trade Off UK. Without further ado, let's get into it. Well, as I said in the show intro, plenty going on this week. It's been another roller coaster ride for the financial markets. So we'll bring Ryan Littlestone from Forexflow Live and Forex Analytics in right away. Ryan, how are you doing? I would ask you how your weekend was, but I've got a feeling you're going to tell me you didn't have much of a weekend at all.
Yeah, what's a weekend these days? You know, it just sails past. And I'll tell you what, you know, the market's the way they are now. If I had hair, I'd be losing it. So, you know, I'm all right.
Well, mine is rapidly thinning. So before we start getting into that debate, let's get on to topical thunder and dig into what exactly it is that's causing us to lose our hair so rapidly. Well, what is it? It's the banks, of course. The collapse of Silicon Valley Bank and all those worries that were isolated to the tech and VC sector in the US. God, that feels like it was decades ago at this point. The focus last week turning to Credit Suisse, and something of a perfect storm for the Swiss bank, which has been, you know, the basket case of European lending probably since the financial crisis. Two things happened last week. Obviously, you had jitters bubbling away for quite some time with Credit Suisse. You then had Harris Associates, one of their long-standing shareholders, confirming they'd sold the last of their stake in the bank. And then the Saudi National Bank, another large shareholder, I think in fact the largest shareholder of Credit Suisse, saying we're not going to provide the bank with any additional capital. So of course this created a crisis of confidence to cut a long story very, very short. Towards the tail end of last week, despite the Swiss National Bank, another SNB, that's going to get confusing, isn't it? Providing a 50 billion franc liquidity line, we still saw outflows between 10 and 15 billion francs a day towards the tail end of last week. So it was clear Credit Suisse couldn't carry on. The inevitable happened over the weekend. UBS purchasing the bank for around $3 billion. I think, let's be honest, they were told that they were having to buy the bank because otherwise the confidence in the Swiss financial system would have just been shot to bits. So the Swiss government bending some of the takeover rules, the SNB providing a chunk of liquidity to help this shotgun marriage get over the line. But I guess the problem now is looking at trade. I mean, we've started to go a little bit more risk on as we move into Monday afternoon, but the market still seems very, very shaky indeed. Bond yields are moving lower. CDSs on banks are moving higher. So the real question I'm asking myself, Ryan, is this doesn't seem to have settled many nerves. Is there worse to come?
The $1 million question, as they say. Yeah,
I asked you rather than answering it myself.
I went to bed last night thinking, all right, the news that's come out, you know, Fed liquidity, central banks liquidity, offering the swaps again on a daily basis, the UBS takeover, everything looked pretty good, and risk looked like it was going to do fine last night. I come in this morning and the world's burning again. And now as we sit here to do this, everything's all right in the world again. It's the way of markets at the moment. You know, you can't buy into a theme for any longer than 5 minutes. You've really got to roll with the punches at the moment. Have we seen the end of it? Who knows? I doubt it. But I come back to the same thought each and every time. Is this a banking crisis? Are we going to see the financial system fail? And every time I ask that question, the answer is no. So for all these waves that are going on, and they're serious and they're big and they're market moving, but until I come to the answer to that question, is the financial system broken? Until that answer is yes, you've got to think this is just noise that will pass by, in time, and we'll get back to some form of normality.
Yeah, I would totally agree with you on that last point. I think what's been really interesting, not just about what happened with Credit Suisse over the weekend, but also what happened with Silicon Valley Bank and First Republic Bank and a couple of the other regional banks, and I think Signature Bank was another one in the US, is the speed and the decisiveness with which policymakers have stepped in. And of course, we saw this over the weekend as well, with those dollar swap line operations being moved to daily rather than weekly, as you alluded to. And I think that really shows that policymakers are rightly so trying to avoid the financial system seizing up, rightly so trying to avoid a repeat of what we saw in 2007, 2008, 2009. And as you say, I'm very much with you on that point. I think for now, the risks of that sort of situation look relatively contained. If you look at where the issues are, Silicon Valley Bank, we know that's a little bit idiosyncratic. Credit Suisse, I mean, they've been struggling, shall we say, to put it politely, for years. I think we could probably fill an episode of The Trade-Off with just Credit Suisse scandals. So you ask yourself, is it that surprising? No. But again, is the volatility that we've seen in the market as everyone tries to digest and dance around these headlines as they come in, is that surprising? No, it's not. I think it just once again comes back to a point you made a few weeks ago around risk management takes on extra importance, keeping stops tight, keeping your position sizes down, and adjusting your trading style to suit the markets that present themselves.
Yeah, exactly that. We have a lot of volatility. Volatility can be good for trading. It can also be bad for trading. Just as quickly as you can make money, you can lose it. So you have to be nimble with your trading. If you get in a position, if you manage to get on side, get some pips, take some money off the table, bring your stops up behind, lock in the rest, reduce your risk, and you should be able to sail through it making some money.
Well, fingers crossed. That's what we all aim to do. Let's have a look at the US. I know you want to talk about some US data, which has certainly been overlooked given what's going on.
Yeah, well, I think overlooked is the key word there. We've got, as I say, it seems like a lifetime ago we came out the Powell week, the Humphrey Hawkins week, the NFP week. The market looking at, is the Fed going to take rates to 6%? Drop, I don't know how many banking crises we've had so far, 2 or 3 in a week, and things have vastly changed. So I think there's 2 things going involved in here with the US data. We're seeing a bit of data divergence once again, and we've seen this historically, way back in sort of 2015, 16, as we moved away from everything that went on then. And this was a bit of a data divergence. So at the moment, we've had the latest numbers for manufacturing for March. The first numbers from the Empire, Philly Fed, pretty shocking numbers. Jobs numbers, we know it's still strong. We had another strong NFP, 311,000. Jobless claims still running steady. Housing, we've had a little bit of a pickup in the housing market, starts and permits last week coming in pretty strong. CPI is down. The headline number dropped 4 pips to 6%. The core's still a bit sticky though. It only dropped a pip to 5.5%. So inflation-wise, still some sticky areas, and it's all about the core at the moment. PPI, it dropped back as well, 4.6% from 5.7% prior. So there are still parts of inflation moving. Then we got the Michigan Consumer Sentiment Survey on Friday. Only a small survey, but it showed soft numbers again for the consumer, and inflation expectations dropping. 1-year inflation dropping to 3.8% from 4.1% prior. So if you take everything as a whole, the Fed is probably right to go 25 basis points at its meeting, but now you have to throw in everything that's going on with the banking stuff, and will that affect their mood or what they say and how they see rates moving forward?
Yeah, that's a very good point. I don't want to talk about the Fed too much because I'll be stealing your thunder quite literally from about 5 minutes' time. But I think one of the key things for me at the moment, and perhaps I think the reason why this data is being overlooked, is because even, relatively coincident indicators such as the Michigan survey, which you mentioned, they're still referencing an economy which was as it was before we started to see these issues with regional banks in the United States. And I mentioned that rather than Europe because we're obviously looking at US data. And I think it's important because we now all fully expect expect lending standards to tighten pretty significantly in the United States, both to consumers and businesses. Credit growth, the pace of credit growth is going to slow. This all equates to, depending on who you listen to, between 50 and 150 basis points worth of rate hikes, as if the Fed had raised the Fed funds rate to that degree. And I think in that sort of environment, actually, any data that references a period longer than about a week ago, for me, I mean, I know it's my job and I'm paid to look at it, but actually most of it's coming in and you're going, oh, that's all right, fine, and casting it off, because the economy has moved on so quickly in such a short space of time that it's just not relevant anymore. And I agree with your call, and we'll get on to it in a second, that the Fed should go 25. But in many ways, the data that's coming in isn't really helping the market at all. And we're actually flying quite blind, and we have been for the last week or so, because we haven't heard from any Fed policymakers. And the data that's been coming in has been referencing an economy that doesn't really exist anymore and has changed leaps and bounds from when that data was collected. So makes our lives rather difficult, doesn't it?
Yeah, and when are our lives ever easy? But you're quite right. We've seen retail sales dipping. You had a strong January. It's pulled back again in February. So, yeah, how the market assesses this data, some up, some down, divergence, whatever, is what we're going to need to look at moving forward. And hopefully the Fed will give us some indication of that.
Yeah, most definitely. Well, we'll get on to the Fed in a second. I wanted to talk about the Bank of England first, the old lady of Threadneedle Street, 2 minutes from where I am sat here in the city of London. Goodness only knows what they're going to do on Thursday. Blimey, this is the Bank of England have been quite tough to call for quite some time now. Throw in potentially systemic financial risk and you get a whole different kettle of fish. My gut feeling says they should hike 25 basis points. They've telegraphed that relatively well. Inflation is obviously still north of 10% here in the UK, although we get the latest CPI figures on Wednesday morning, about 18 hours before we hear from the BoE. And the labour market remains tight. We got the latest jobs numbers last week, unemployment holding close to record lows, earnings increasing by around about 6% on a yearly basis, which is cooler than inflation, but still a relatively rapid clip. But of course, with the Bank of England, you've got to remember that not only do they, through history, have a bit of a tendency to look for any excuse to either avoid raising rates or bring the hiking cycle to an end pretty quickly after it's got underway, but also recent commentary has been relatively dovish as well. You've got Tenreiro, for instance, talking quite openly about cutting rates. Dingra dissented in favour of keeping rates unchanged at the last MPC meeting. So I think the risks here definitely tilt to the more dovish side. It's not the biggest stretch of the imagination to imagine a few others joining that sort of dovish dissent. I think in that sort of environment, although cable is trading at roughly 1 month highs around 122.60 at the time of recording, I think the risks to the pound here are probably tilted to the downside, given risk appetite is relatively fragile. It's tough to imagine the BoE being hawkish. And actually, I could see a decent case to be made for them staying on hold, bringing the hiking cycle to an end, saying the next move is going to be lower in rates. And I think actually the old lady could be a fairly chunky headwind for the pound to contend with this week.
Yeah, we know we're going to disagree on this, as we often do. I still think that
I knew you were going to disagree with me.
I still think the BoE is going to be forced higher than they expect. Inflation data on Wednesday, as you say, is going to be a hot print. If it comes in much higher or doesn't drop as far as expected, I think the market's going to take that as the BoE perhaps needing to do a bit more. But then on the flip side, if you have to look at the central banks, the ECB, they went there 50, and they differentiated between monetary policy and financial stability, if you like. If there's one bank who will probably pause due to potential financial stability things, it's going to be the Bank of England. So I think they probably will hike 25, but I think there's a greater risk they don't do anything at all and blame the financial stability side of things on that.
Yeah, I would agree with that. I think the old lady, the MPC, is going to be sort of dragged kicking and screaming into a 25 bips hike. As you say, the ECB went 50 last week. We think the Fed are going to go 25 on Wednesday evening. It's tough to say. It's tough for the BoE to make the case that they should remain unchanged when inflation's still 5 times their target, and the economy actually is starting to perform better than we expected. GDP grew 1/3% on a monthly basis in January. The PMI numbers are coming in pretty strong, I think close to 9-month highs for services and manufacturing last month, and we get another read on that on Friday. I think the flash PMIs are out. So actually, I don't think there's much excuse that the BoE can use to stay on hold. But as you say, if any central bank is going to find an excuse to do nothing, then it's going to be them, isn't it?
Yeah, definitely. I think that's very much going to be the case. And as we know, anything that has Bailey attached to it usually means the pound drops at some point. So he's always a good indicator.
That is very, very true. What about the Fed then? We mentioned that. Obviously, we've got that on Wednesday evening. What are we expecting there?
Well, rate expectations over the last couple of weeks have just been a real roller coaster. They've been up and down. We've priced in hikes, pauses, cuts. I think Nomura are still going for a 25 pip cut at this meeting on Wednesday. Bit out on a limb with that one, I think. But what I think happened is that the ECB really gave them and other central banks the green light to continue on hiking rates due to economic fundamentals. Them going there 50 signalled, as I say, that monetary policy is separate from financial policy and financial stability, and that they are fighting two fires, if you like, and they will continue to fight the inflation fire. So I think what's more important than the actual rate number, unless it's a shock or they could do a 50 or they do a cut or something like that, I think what's going to be more important is these dots. Go back to the Power Week. The market was ratcheting up the bar of where the Fed may be taking rates. A 50 was on the table, where people like Mester talking about 50s on the table. Powell was talking about 50s on the table and doing more, although he did dial it back in the second appearance. But the market was taking yields right up, looking at where this ceiling's going to go for Fed rates, looking at maybe 5.5%, 6% now. Back in 2020, or looking at 2023, the last dots, they've really... The majority is sitting around the 5.125 mark, which puts the Fed funds rate 5 to 5.25. There was a couple looking far less, 4.75 to the 5 mark, and the upper hawks were well up at the 5.5 to 5.75 area. So the dots are going to be important, and important as well, the 2024 dots, because that's the higher for longer market, if you like. And they're really wide at the moment. At the low end, you got the 3 to 3.25% dots. At the top end, you got 5.5 to 5.75 dots. The majority are still sitting quite low, around 3.75 to 4.25%. So 2024 is going to be your higher and the longer part of the trade, but also the short term, the 2023 dots. Are we going to see that shift up much closer to the 6%? I think if the Fed stay the course and they move the dots up there, then the market's going to react. Yields are going to rally, and obviously the dollar's going to rally as well.
Yeah, most certainly. I mean, I think, as you said, market pricing has been absolutely all over the place. The last time I checked, I think we were pricing, and again, this was this morning, so it will have changed since, around about a 70% chance that the Fed remain on hold, which seems rather over the top in my mind. I wouldn't be surprised if that changes another 10 times before we get to the Fed meeting on Wednesday night. I think you're absolutely right to focus on the dots. I think that really is the key thing to look at. Do the Fed, I mean, the questions I'm going to be asking myself going in, and also over the press conference, because Jay Powell will stand there and say, don't place too much weight on the dots, knowing full well that everyone will place a lot of weight on the dots. So, begs the question, why publish the damn things? Anyway, I think the questions I'm going to be asking myself are, are there enough policymakers that think rates can still move higher? Because, of course, before the blackout period, that's what everyone was saying, from Powell downwards. We're going higher than the markets expect. We're going to stay there longer than the market expects. Is that still the consensus view on the FOMC? And you mentioned a really interesting point about the 2024 outlook. And I don't think this is something that's going to get resolved, given what we're seeing in terms of financial stability risks. But that dispersion, that gap between the highest estimate and the lowest estimate, absolutely huge at the last dot plot in December. So do we get a little bit of a tighter dispersion? Do committee members come around to a little bit more of a consensus view on where rates are likely to end up? Or do we see these sort of bitter divisions not as bitter as we're seeing on the NPC, but still relatively significant divisions on the FOMC persist as we move into the next 18 months or so.
Yeah, I think that's going to be the case, and it does show divisions. We know there's hawks, there's doves, there's people who are more neutral, and I think where the majority of dots now sit, if those for 2024 are up, high fours, maybe up to 5.5%, that's where the bulk of the dots are sitting. That's going to reinforce the Fed's path that we're going higher for longer.
Yeah, most definitely. Well, with that said and done, let's get into a few charts in That's a Setup. So I want to look at gold, first of all, this week, not just because I'm wearing a golden tie for the special occasion, but gold trading north of $2,000 an ounce when priced in US dollars after the European Open this morning for the first time since March of 2022. The reason I mention US dollars, you may ask, is because actually gold is already trading at an all-time high when you price it in Aussie, when you price it in sterling, when you price it in euros, you price it in pretty much everything other than dollars. We're already at an all-time high for the yellow metal. And pretty much everything is working in its favor at the moment. You've had a massive amount of haven demand come into the market last week. Yields, both nominal and real, absolutely cratering across the curve. And of course, the dollar trading softer for, I think, a third week in a row last week. So everything working pretty well for gold. It feels like if we can get a closing break of this 2,000 mark, which we might not get today because we have backed off a little bit since breaking above it this morning. But if we can get a closing break of it, then it looks like it's going to be sort of all steam ahead for that prior all-time high around $2,070 an ounce. And actually, I think all the time that there are jitters in the market around what's going on with banks, all the time that Treasury bulls are in control of things, I think any dips in the yellow metal are likely, in my view, to be bought into relatively quickly. What are you thinking here, Ryan?
Yeah, I think you're spot on with that, Michael. It is a safe haven play. We've heard that a lot of hedge funds are putting their money into it. You want the risk of bank stocks at the moment, or do you want to put yourself in something that's a bit more stable? And, it's definitely seeing a run yet. I think 2000 is going to be a real big level. It's already shown up once. I think 2009 we got to this morning. It's already shown up as a very, very strong level, psychological level, whatever you want to call it. So, yeah, I think that's going to be a really big level. Can it make those all-time highs? I think we're going to have to see things get a lot worse, but it's definitely a market that's going to be a buy the dip market.
Yeah, definitely. I think it's certainly something to keep on the radar. What I would say, I think your point about havens is interesting because havens seem a little bit thin on the ground at the moment. If you look at what's actually rallied over the last week or so, treasuries, gold, and the yen. What else would you normally add to that mix? Well, the dollar, but why would you buy the dollar when treasury yields are down 70 odd basis points in a week at the front end of the curve? And the Swiss franc. And, I'm not sure we need to elaborate on why you might not be the biggest fan of buying the Swiss franc at the moment. But speaking of treasuries, let's dig into, the 2-year that you wanted to look at.
Yeah, this is something we looked at last week, and I've sort of done a bit of crafty artwork here with my charts. I've split them in two. We've got the yields on the top, and we've got the 2-year actual price in the lower half there. And this is something that we've been looking at the last couple of shows and looking at where I'm trading. And I've got this line here, the Fed midpoint, which is the current middle of the Fed funds rate. And we had that Powell situation. We said we got the yield right up above 5%. Everything was looking hunky-dory and hawkish. And now we're well below this Fed price. And so that says the market has lost faith that rates are going to even go above where we're at now. And obviously we're expecting a 25 pip hike, so that midpoint is going to go up some. But I think what this is going to show us for the Fed, the market isn't going to get over this banking stuff and this financial stuff that quickly. So if the Fed is going to be really hawkish, or if it's going to maintain its path and say, yeah, fine, we're going to 25, we're going to continue hiking, the dots have moved up here, we're going to see yields rally, i.e. the price fall. And I think where we're talking about 2024 is the potential big shifter in those dots. If you get a dip in the price here, I think that's going to be something you want to be looking at potentially to buy and fade. Maybe down towards that level, down around those moving averages, the 55 and the 100 moving average down there. I think that's around about 102.50 50s, 70s, something like that. Get a dip down there, I think the market's going to be soaking it up, and we're going to see any popping yields falter, and they'll come down again, thus the price going back up.
Yeah, I was really hoping we didn't have a chart on the bond market, given that someone on this show, and I've no idea who it was, sat here last week and said, yeah, the curve should flatten. We'll go back to how hawkish we were before. SVB will blow over, and actually ended up about 50 basis points offside on that trade. So I'll own up to that one. Not my best call, not my worst either, thankfully. But I think you're right. I think we are now at a point where things have got to a stage where markets are not, as you say, going to immediately sort of snap back to the hawkish pricing that we saw of, a terminal rate up somewhere near 6%, and the belief that it's going to stay there for a prolonged period of time. I think whether you think what's going on is a systemic problem or not, and to be clear, I don't think it is. I think it's a case of it's now been a bit of a wake-up call to the market and to policymakers that actually if things are starting to creak, and actually in certain places things are starting to break. So rates might not be able to go that much higher. And if they do go higher, they're probably not going to be able to stay there for that long. So I think you're probably right. I think, for me, we've seen the cycle highs across the Treasury curve. And I think the bulls are likely to remain in the driving seat for some time now.
Yeah, exactly that. And I think you're quite right there. I don't think the market can get anywhere close to the hawkishness it was after Powell, unless all of a sudden the magic wand is waved and this banking stuff is behind us and everything's looking good and the data is all turning strong. So, yeah, I think the market's had a bit of a kick in the chops over everything that's gone on, a bit of a definite reprice going on. So, yeah, I think it's not going to give up that bone too quickly.
No, definitely. Well, let's keep our fingers crossed that someone does have that one, because I think we all want to put this behind us. Anyway, let's have a look at the dollar. I wanted to bring up the dollar index this week. The reason why I wanted to do that is because, as I alluded to a minute ago, the dollar's not really been trading how the textbooks would tell you the dollar should trade in this sort of environment. If you had to kind of split the FX market up and go, what are the havens in G10 FX? Well, the dollar, cash, US dollars would probably be right at the top of that list. But as I alluded to earlier, when you've got such a significant dovish repricing of the Fed curve, and also yields absolutely cratering at the front end of the Treasury curve, it's really, really tough for the dollar to overcome those very, very stiff headwinds. And that is exactly what we've seen over the last week or so. The dollar index continuing to move lower. The bears firmly in control here, it would seem. We've had a bit of a downtrend coming into play since the start of the start of March. And I'm sure this is a chart that is on Mr. Blake Morrow's radar, because we know he loves his chart patterns. We've got a bit of a descending triangle going on here as well, with 103.50 and the 50-day moving average at 103.45 marking the bottom of it, and the top of that triangle coming in around 104.25. So a very, very tight range going into the Fed meeting. The reason why I like the look of this is because, as we said earlier, risk management, position sizing, placement of stops is incredibly important in a market such as this. And, frog in the throat. And this sort of chart means that you have really, really nice and obvious levels, not only to see where momentum is moving. If we break below the 50-day, then the bears are in control. If we break above the triangle, then you say that that's a bullish breakout. So that allows you to gauge momentum relatively well, but also it gives you very, very easy levels around which you can manage your risk. And Ryan, I'm going to hand over to you before I start coughing again.
Well, one thing I know, Blake will be very proud of your techer skills there, Michael. Young Padawan, you've got it all there. You've got everything there. So, he'll be very proud of that. And, I think, again, you're absolutely right. We don't disagree on too much these days, do we? But I'm sure we will in the future. But, one thing you got to look at the DXY is that it's heavily euro-based. So whatever's happening in the euro is a big driver of this. And we've spoken about the euro before. It's been in a really, really tight range, which has perhaps kept this in a tight range as well. But when you get a wholesale move in the dollar, everything going the same way, then it's going to look a bit iffy. And as it hits those big levels, that's when the market goes, okay, well, now you've got a bit of work to do if you want to continue selling the dollar, this is the sort of areas that we're going to put up a bit of a fight. And if you want to take us on, you've got to do some real pushing.
Yeah, most definitely. The dollar index, as you said, it's a very crude representation of the dollar's performance. There are equal weighted or trade weighted indices out there, but the problem with those is they're not particularly looked at, and they're not actually traded by that many traders, or also offered by that many providers. So the dollar index is the best we are going to get. We have agreed on a lot in this show, but I've got a feeling we might disagree when it comes to the pound.
Let me guess, you think it's going to zero. Yeah, we're looking at cable here, and this one is a trade I'm potentially looking at. It needs a few ducks to be lined up for it to happen. And what I'm looking for in the pound here is perhaps a hot CPI on Wednesday, just before the FOMC. Maybe, as I say, to get those expectations, at least in the short term, running a bit hotter for the Bank of England. That'll likely get the pound higher, particularly if the market's still a bit edgy over the dollar. We could get cable up towards that 124 area. I'm going to throw in the usual caveats. This is cable. It could be 124 by the time I finish this sentence. But anyway, that's what I'm looking for. Get up there. And then if the Fed do continue on their path, if they do the same as the ECB, go the 25, say we're going to continue hiking because of the fundamentals, you're likely to see a dip in the dollar. So I'm looking to short perhaps into 124, run it into the FOMC, get out on that dip, and then maybe turn that into a long because of that hot CPI report. Might mean that the Bank of England are potentially more hawkish at their meeting. So really want to try and play both ways, or every which way but loose, as they say.
Yeah, as you said, it is cable, so this could really end up anywhere. I think 124 is a bit punchy, in my view. I mean, I think even if we get a hotter than expected CPI number, I think the market will probably look through that. And the reason I think the market will look through that is because it expects the Bank of England to do the same. I really struggle to see how the market is going to price in any more than one more 25 basis point hike from the BoE. And actually, I think if the market were to do so, then that is something that is worth fading. And I'm not thinking that the pound is going to go to zero. And I am actually more optimistic on sterling than I have been in quite some time. But I still don't think it's got particularly much going for it. As we alluded to earlier in the show, if anyone is going to pause rate hikes at the minute, it's going to be the Bank of England. If anyone is going to loosen policy before anyone else, there's a decent chance that will be the Bank of England as well. And although things are starting to look a bit rosier, some of the Brexit stuff getting sorted, the UK probably going to avoid recession this year based on what the OBR are saying. I just really struggle to bring myself to be long sterling at the moment. But having said that, I would not be at all unhappy if I was wrong there. Particularly, it would make our summer holidays just that little bit cheaper, wouldn't it?
Depends where you're going, doesn't it?
Well, exactly. That is very true. That is very true. With those charts out of the way, let's get on to our plays of the day. Well, as I said earlier, I think my play of the day last week shows the importance of not being married to a view and cutting your losses when you can, because I think I would have cut my losses on my curve flattener trade about 2 minutes after I said it last week, such is the volatility that we saw in the market. Anyway, that doesn't do us much good for our little bet that we've got going with the guys down in Melbourne, if that's ever happening, by the way. I have let the UK side down, and for that I apologise. Let's hope we can get back on track this week. I want to look at dollar yen. The yen is, as I said, the market's kind of preferred safe haven at the moment, and dollar yen is being held lower by not only that haven demand, but also the softer dollar that we're seeing coming through and the chunky decline that we're seeing in treasury yields. On a technical basis, we're below the 50-day moving average, and we've made a closing break of that level on Friday. We tested it in early trade this morning, and thus far we're looking like we're managing to hold below it. So that, again, puts the bears in a little bit of control here. When we look ahead, I think if you look to the Fed meeting on Wednesday, they'll probably go with a 25 basis point hike, but I think the bar for a hawkish surprise is one that they are unlikely to meet. I think it's tough to envisage the Fed wanting to do anything more aggressive than the market is currently pricing, given how jittery everything is at the moment. So I do like the look of dollar yen lower into around 130. As a first target. And then, of course, we've got the prior lows below that, which come in at around 127. I think that's much too much of a stretch for the next week or so. So again, fitting with the kind of broader theme of keeping your stops tight and focusing on risk management, I think a very, very tight stop, targeting a break, couple of points below 130. That will do me very, very nicely indeed if it comes off this week. Mr. Littlestone, what about yourself?
Yeah, well, just quickly on your trade last week, your flattener, I think you've done the right thing. We put analysis up here, but if you're trading, if you're wrong, particularly in these volatile markets, there's nothing wrong with getting out, protect your capital, move on to the next trade. There's absolutely nothing wrong with that. And, I've got to give props to Blake on the Forex Analytics team, because he's been in shorts in this one pretty much from 137s, 138s, and he keeps adding and getting out and adding and getting out, and it's worked out a wonderful trade, and long may it continue. But my play of the day, I'm going with something I went with last week actually, and that's Euro Sterling, because I don't believe you can change a winning team. And when we did this last week, we were round about. You can just see that yellow dot on the screen there. That's where we were then, and my play was to buy into the next support, which was down at the top of that zone, the 88 big figure, down towards a bit of a push down towards 87.70, and that worked well. We got way back into the 88s. We've now broken down that, but once again, I'm looking at the support areas for this one, and we've got another big support area. It bounced off of there last Wednesday, down around the low 87s, 87, 18, 16, I think it got down to. Very strong bounce from there. We've come back perhaps a bit too quickly, and I don't like prices that come back to a strong level that quickly. But this is Euro Sterling. You can take some of the volatility out that we're seeing in cable and Euro Dollar and Dollar Yen and all the other majors, and it is one that does play quite well in the low vol environment. So still looking at longs down into this 87, 15.20, down to the big figure, below 86.90, 86.85. Where you're wrong, and we're heading lower. So longs into this area. Conversely, you get a move up to the 88s, 88.20s. That's where the rally sellers are looking the strongest. And if you get a move up there, you get out your position if you're long. Maybe look at flipping to shorts.
Well, there we go. Let's keep our fingers crossed, at least for me, that comes in, the short dollar yen idea comes in a lot better than last week's. Another busy show. Thank you for sticking with us. Thank you for watching, as always. I'm sure we will have plenty to get our teeth into this week, and I think my hope for the week is that things quieten down just a bit and we can have a little bit of a weekend at the end of it all. In any case, as I said, thank you very much for watching. Thank you also to Ryan Littlestone for joining me as always, and also thank you to our producer Kyriakos for pulling this together, as he always does so brilliantly. All three of us will be back this time next week. In the meantime, drop us a like on the video, leave a comment, let us know how you're trading the markets, and if there's anything you want us to take a look at next week, and we will all see you then. Thanks again, and goodbye for now.